Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about that proposal on a 50-year mortgage that we got over the weekend. First, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast. I know you are so excited.
I got my Christmas sweater on early because I get my charts back. I am very, very happy. God, that was painful, man. Oh, all that time and all this data. And I'm like, I can't put my charts up because I don't have the tables and stuff. So very happy that the shutdown is over. Boy, the airline thing really got people going. Like
that seemed to be, and I think you said that early on. You were like, yep, as soon as we start massively missing flights. I mean, it's a huge part of the economy. It's a huge, it's something that affects everybody or a lot of people.
There's always pain points, and they picked this one up, and it really did force people to start moving. But wow, what a weekend!
Yes. Okay, but wait, I want to talk about your charts for a second, because my question was, like, last week was supposed to be a jobs week. This week was supposed to be inflation week. Do we know yet when we will get the data? Will it be looking backwards, or is that data just gone?
We have no idea yet. I'm trying to figure that out on how they would, because they've got to do the work. They've got to gather up all the stuff and do the work. So I'm sure they're going to give a date and a time where everything gets released from the previous and then start the schedule. So, but again, they have to sign the bill and everything, and we take it from there.
And of course, we are recording this on Monday. On Tuesday's Veterans Day, national holiday, so they won't be working then, I would assume. So it might still be a little bit.
Yeah, might be a week. I mean, it just depends. But I mean, we've gone past this stage, so it's good. We can get to our normal data lines back, and that's very important at this stage. It was like the worst time to have no data, right in the middle of everything. So what's going on with policy and everything. So, but it is what it is. It's past. We move forward with it.
We move forward. Okay, so let's talk about the big news this weekend was Trump's announcement that a proposal, really throwing it out there, right? Doing a test balloon to see what people thought about the 50-year mortgage. So let's talk to you, Logan. What do you think about the 50-year mortgage?
Sarah, you didn't know me in the last decade.
I did not.
But you did kind of. Because Sarah Wheeler in 2014, somebody nominated me for top 40 under 40. And
it's a Rising Stars Award.
Sarah Wheeler was the person who rejected, the application. And then she didn't believe it that she did. And then they went back and looked, and it was you that signed it off. So
it's so terrible.
It is fitting. It is fitting that I'm here right now. And we are, talking about this from the rejection that, Logan wasn't good enough, back then, but now he's the chart daddy. So turnabout's fair play.
Okay, well that is true. I still feel bad about that. I was like, oh no, maybe it wasn't me. We went back and looked. No, it was definitely me. So anyway, okay, I have to pay my penance on that one. Okay, so let's talk about the 50-year mortgage, because I know you think, when we've talked about the 40-year mortgage before, you're like, that's a terrible idea.
So in the past decade, I always talked about, if they ever allowed a 40-year mortgage to come in, I would go to Congress and testify against it. And I would list the reasons why. Now, in the last decade, housing was a lot affordable. We had low mortgage rates. Mortgage rates ranged between 3.25% to 5% for 10 years. We had a lot more inventory back then. There was tons of choices. It was the weakest housing recovery ever. And that was my whole premise, from 2010 all the way to 2019, when I did my work back then, before I joined HousingWire, that we would have the weakest recovery because household formation, demographics, there was all these variables that, in there. So people started talking about, maybe we should do a 40. I said, no, the 30-year fix is fine. If you amortize to subsidize demand in a sector that is very subsidized already, you're not allowing the process of healing to work itself out. So we are here today, October of 2025. What do we know as a fact? Number one, why were we team higher rates? Early 21, we need inventory to grow. Inventories grow, right? It's no longer a savagely unhealthy seller's market. Number two, we needed the home builders to be put on their bleeps, because they were pushing prices up. They were canceling contracts and getting people to pay up. They can't do that anymore. So they're making deals. And their completed units of sale is up. So the marketplace corrected itself in terms of getting more supply, and the supply and demand equilibrium gets fixed. If you amortize something, and they just went straight to the 50, they didn't even mess around with the 40. All it is you're subsidizing a marketplace that is already very subsidized. It prevents the supply and demand equilibrium from working right. And boy, like when we wrote those articles and we showed the net interest cost, of course, nobody's going to hold their mortgage for 50 years or even 30 years to a degree, but the lack of equity build and the upfront, just for something where if mortgage rates just fell a little, can change the dynamics. It's so not worth it. And it was encouraging to see that X or Twitter, where everyone really hates each other, this was one thing that united the clans. I mean, this was like Braveheart all over again. Everyone was just like all in on this. And I thought the explanations we gave, especially on the Instagram live, that, this isn't a healthy outcome. The 30-year fix is already very subsidized in itself. The tax policies, everything is kind of rigged for housing to get here. And if you have an affordability issue, it has to work itself out over time. Price growth slows down, wages rise, then rates fall, and then you get, demands picking up again. And you look back in the last few decades in housing, that has occurred before. I take 2008 out of the equation. We've dealt with situations like this, and in over time it does fix itself out.
Yeah, I think when I wrote the story about like what does a 50-year mortgage cost the consumer, right? What would they end up paying? I was so surprised because I thought if you stretch out 50 years, that monthly payment would be so much lower. But it's really not. It's a couple of $100 lower a month, and then you're paying like twice the interest, obviously, because it's a really long loan. So to your point, no one's going to keep it 50 years, but like an ARM loan would be better. Or I mean, there's other options besides this, right?
It's one of the things that people at first they were doing like an apples to apples with the same rate, and I was like, no, the longer the amortization, the higher the rate is. So I modeled something out for people, and 42 to 57 basis points higher in rates for a 50-year amortization, using a 2030 model out there for a 40. You could get that area. So it isn't like the massive savings that people thought, but when people saw the interest, like everybody just like what the and the lack of equity buildup as well. So yeah, it's just I my whole thing in the last decade was never fighting the people that said lending is tight, we need to loose lending. I said no, we're not. We're still very liberal. We have FHA. When the next downturn, or when home sales collapse, don't worry about it. Homeowners are doing good. We ran the gambit on this for 3 years, and over the next 100 years, nobody could take this away from us. We never flinched. We said homeowners in a good spot. New listings data never took off, never even got back to normal because homeowners are good. But amortizing a 30 to 50 year just subsidizes the market even more and doesn't allow that supply and demand equilibrium to work out in itself. Time, and this is the problem with having, you can look at housing in two different ways. Number one, you could say that this is the third calendar year of the lowest home sales ever. We're going to go into the fourth year. There comes a point where people start, getting really upset, and you could just see from the start, the White House was very, on this because they see so much of the dislike in the economy. Federal Reserve staffers that housing is life. Housing is progressing forward. Housing is dating, having sex, getting married, having kids, going into the future. It's this whole equilibrium. And, when you get sales depressed for so long, you get stuff like this. And I'm just standing my ground that I was like this in the last decade. I'm this today. I'm going to be this until the day I die. The supply and demand equilibrium is working itself. And we cannot subsidize something to 30 to 50 years and have less equity build out and more interest costs and stuff of that nature. So I'm glad to see that this was a unanimous take on this. And even Bill Pulte of the FHFA kind of somewhat walked it back to a degree the next day, talking about, this is just one of many things. And I thought the visceral reaction that everyone gave on this idea was good to see, because housing's
I
very
agree.
subsidized. It's a very subsidized marketplace. But when you have a sector of the economy where you tell people this is your home, you want to live here, but also it's your best investment. It's a problem, right? Because you can't make your house your best investment, or if the job is to keep it inflated, that you have periods of times, and that's what COVID was.
Okay, so I did think it was interesting to get that sort of unanimous, like people are like, "Oh no," and Pulte put out a tweet that said, "We hear you." So we got the message, right? So, and again, a lot of times, this administration, especially, everybody has always done trial balloons, but they do it like they put it right out there. The most, kind of some outrageous stuff. I think about what they've done with the GSE release, putting the AI picture of him at the stock exchange with the new name and all that kind of stuff. And then they want to see what the reaction is. But this reaction was huge.
And who was the ringleader
So
of this whole thing, over the weekend?
you definitely were the one that was like, oh, heck no. It reminds me, Logan, like when Joe Biden, in the first month of his presidency or so, he was coming up with a lot of things that they wouldn't have helped because the market at that time, right? There was just too much demand. And he was like, oh, we're going to make we're going to help you with down payments, or you're going to get a better thing if you've never been a homeowner. We're like, wait. Don't make the demand side better. At that time, we needed more help with supply. Like the demand side wasn't the problem. What do you think the problem is that they're trying to solve here, that you're like, the better way to solve it is X?
Time. I mean,
because they're trying to solve affordability.
They're trying to solve affordability by subsidizing demand even more, and that's just, I say this because I wouldn't have been team higher rates in 2021 early if I didn't think this was going to be a savagely unhealthy outcome, because it would take time to fix this. Wages rise, household formation, dual incomes, price growth slows down, right? It works itself out. And I show people, like over the weekend, people said, but it's never going to get better, because I said, we have the 1980s as a really good example. And unfortunately, not a lot of people remember prices were escalating out of control in the 70s, and mortgage rates went up to 18%, and home sales crashed in the 1980s. Inventory was much higher. The credit data was worse back then. Home prices didn't fall. They weren't negative, but adjusted to inflation, we had some negative years. And during that time frame, wages rise, rates fell, and the equilibrium over time worked itself out. And that's, unfortunately, that's the healthiest thing that could get you there. So I understand the desire to get a quick fix, but this is probably the least effective way. And I say this, because a lot of people are, one of the well-known market players on social media was saying, housing's getting worse, or new home sales getting worse. And I said, that's not true. And I said, we have models that we work with, and when mortgage rates get from 6.64 down to 6, the builders, their confidence data gets better, their purchase application data gets better, and their new home sales get better. And said, new home sales at a 3-year high. And people go, well, that data is wrong. Yeah, I admit, I was the first person to admit it's going to get revised, but it's getting better. And the problem is, if rates were just staying at 6% for a long period of time, I don't think we even have this conversation, because sales start to grow and people start to feel a little bit better. But the problem is, when rates get down to 6%, I went back and watched the CNBC interview I did like 5 weeks ago, where I basically told CNBC, the Fed freaks out because if people have sex and they buy homes, they buy more stuff. And what Neil Kashkari said in 2023, how are they supposed to balance out our economy if mortgage rates get near 6% and housing shows life? And they stuck with that model all the way. And this was before, Powell came out and was very hawkish about the next rate cut. They fear this for some absurd reason. But in any case, inventory's up, price growth is cooling down. There's no more massive seller market. The seller market was terribly unhealthy in that, where the sellers have way too much power. And mortgage rates get down to near to 6% or the high 5s, and housing picks up a little bit, it's going to be okay. You can't be one of these, well, you can't have rates go lower because prices go. Prices have gone up pretty much every year since 1942. This is a defeatist mindset that we have to crush demand for 10, 15, 20 years to maybe no, you don't have to. You have to find that supply and demand equilibrium and let the marketplace kind of work itself out. This is why I'm not an advocate of easing lending standards, or a 40-year mortgage. God, a 50-year mortgage would be even worse. Inventory is growing, price growth cool downs, wages are rising still. Where rates go down a little bit, you get a little bit of demand and it picks itself up in household formation, and we just go from there. But subsidizing demand to this kind of level, I can't endorse. And I'm just staying true to myself as I was in the last decade, as I am today, as I was 2 years ago, last year, will be for till the day I die.
You're very consistent, especially on this. You're like, no. Okay, so you talked about a little bit already, but the tracker data, right? So we saw inventory. We saw something strange happen with inventory and pending sales. So walk us through that.
So I was waiting for inventory to hit a yearly high. I did not believe that the peak was in August. So I was sitting there for months and months and months and waiting for inventory to increase. It wasn't happening. So the growth rate of inventory with our data line at one point was 33%. It got down to 16. But I was still close enough to get it. And what's happened is before this last week, the 3 weeks, we had the 2-week holiday that messes up the data, of course. We had the AWS outage, which caught a day. And then we had 1 week where inventory went up a lot, and it gave me my yearly high. And then it really, it was just very wild. Now all of that is kind of out of the equation. So it does look like if I adjust it to the proper model, we never got back to a yearly high. We were just slightly lower. And this week, inventory fell noticeably. Our weekly pending sales showed 15.5% year-over-year growth. That's very big for a weekly pending home sales print. But this week, it looks like seasonality is a big driver. And last year at this time, mortgage rates went up to 7% back then. That's when the 10-year yields started doing a sharp reversal, and that impacts the weekly data. So we have a very, very low comp on the sales data, and seasonality kept in. Because if you saw that right away, you're like, whoa, that is a big drop on inventory. Price cut percentages falling, year-over-year growth rate, but there's some variables in there that you have to take it in context. So it was a good week. Pending sales are up. The inventory data looks normal. We still have over like 16, 17% year-over-year growth in inventory. Very healthy marketplace. Price cut percentage is still elevated. That means the buyers have a little bit of more say in this market than they had the last few years. Not a little, but a lot more say now. So looks very good, looks very healthy. See, the thing is that I look at 2025 very healthy. I looked at late 2020, all of 2021, and early 22 as unhealthy, very unhealthy, savagely unhealthy. So it's just working itself out. So, get rates down here, just keep them down here, get it going. Forward guidance, Fed staffers, forward guidance, man. I tell you, you got this layup right there, and we just push it off and getting ready for 2026.
So do you think, so this was the longest shutdown in history, but still, not that long. I mean, it was a little bit over a month. Do you think we're going to see any jobs data does this affect any of the jobs data?
I would say that, I just remember in the last shutdown, housing data slowed down during the shutdown. Of course, things take longer. I do assume that we're going to see this in the existing home sales report coming up for this week. And then it just kind of rebounded back to trend. So whatever weakness we see in the data because of the shutdown, the Fed's going to take it with a grain of salt, because then things are going to come back. So there's other data lines that I track that are a little bit maybe too nerdy for people. And everything was okay. Nothing breaking too bad out there on the consumption side. So I'm glad it's over. We should get things going again, because you really need air travel, for holidays. Because the problem is if you don't have air travel during the holidays week, the consumption data starts to get hit to a degree because, hotels and all this stuff. And it really puts the data lines into a very bad tail. So it's good that we got it up and going again. I know Trump was really advocating, hey, everybody who works at air traffic control, everybody get back to work, because really the airline story got this thing going.
Yeah, listen, I have big plans for Thanksgiving. I need that air traffic controllers to be there. I need air travel to be good. So I'm going to go to Scotland and see my daughter who now lives there. How fun is that?
A Scottish Thanksgiving?
Okay, wait. Okay, can you bring out your Scottish accent? Most people probably don't know you have a Scottish accent. I mean, that you can do this.
Ira
Give it to
McGregor, are
us.
you trying to go to yourself to see your little daughter in Ireland? No, I don't think. Wait, wait. Is that Scottish?
I don't know. I
You
don't
know,
know. It sounds Scottish to me.
I in my old acting days, I used to do voiceovers, and then uh, the mortgage spreads were good today. So of course, I'm bringing Jodeci out, and forget hugging a mortgage spread, give it a kiss now, because we literally would not be near 6% without mortgage spreads improving. We'd still be fighting that 6.64 and 7 level out there. So I was thinking I could do my Sean Connery impersonation that mortgage spreads do look savagely sexy this year compared to the past. So
Very fun. Thank you for doing that for
Logan was
us.
wild back in the 1990s. So
Oh, Logan is still
there
wild,
was no
man.
charts back then. It was just not. It was all different.
I did want to say I wanted. We just got out of a meeting where we're talking about the Housing Economic Summit that is coming up in February, and people need to be planning for that now because you're going to be there. You're obviously our featured speaker. We also are going to have Barry Habib, and this is going to be fun. Many people in our audience know him from MBS Highway. Of course, now he's also on the Fannie board. Um, and you're gonna have a session, he's gonna have a session, and then you guys are gonna be on stage together. We're gonna have a Q&A. It is gonna be so much fun. So people need to sign up for that. Don't wait because prices are about to go up. I just got out of that meeting. So and it's gonna be really amazing. Last year was great, and I feel like we learned things from last year and gonna make it even better.
I always think it's nice when you have so many economists and data analysts in one day. Like that's
Yep.
not fair. Like it's usually, like when I go speak at an event, I'm probably most likely the only economics person. But here, we have the economists for the NAR, Blight, Barry Habib. We're gonna have about 8 or 9 more economists and data analysts out there to talk about. So this way, you get a full kind of view of what multiple people are thinking about out here. And the Q&As, for anybody who's seen the Nerd Tour live, the Q&As are a lot of fun. Right, it's a lot of fun for me, and when Barry and I get to do it, and everybody in the audience we're going to be familiar with us both. I think that'll be a very special treat.
I do too, to see like where you guys agree, maybe where you have a different take and why. Also, I will say that we've structured this so it's like a session on, sort of like the here's what's happening, and then we have like a tactical session after it where people are talking about how they're going to apply that data into their job. So it's very focused on like you get insights and you're going to be able to take it and do something with it. So super excited. Everybody mark your calendars.
I know it just makes it feel like that rejection in 2014, Sarah. That you came and called on to me and asked me for help on this, and I thought about this is the lady who said I wasn't good enough in 2014.
Listen, all of our award programs are super competitive. They were then, they're even more now. So, but
Sarah, just for you're not even the worst person back then in my mind. I made a joke in 2013. I applied for all the economist jobs. I was a loan officer, just having a little blog, and I applied for them, and I told them all in 2013. I do not have the qualifications for this, clearly, because I don't have a PhD in anything. I just wanted to write this application and email here because 10 years from now, I'll be the best housing analyst in America. And I sit here and I joke about it because some people remember that. And one of the people who responded back to me back then ended up working with the economic team at the White House, and he even said, "Oh no, Logan, you do really good work. I just don't think this is. Oh no, I know this is not it. But 10 years from now,
you're like, wait and
they'll
see.
call me the chart daddy. I'll have a lot of big hair, and
No.
we'll be fighting the American bears and the Russians and the Chinese and Iranians disinformation." And I just wanted to leave this here just to remember. So thank you, Sarah Wheeler, because I'll never forget. You're really the person that rejected me back in 2014.
I was. Oh, yeah. Well, we appreciate you now. Thank you so much for being on.